Welcome to Options Brew and good evening. I'm your host, Lex, and tonight's special guest. We have two for you tonight, two great gentlemen, Adam Johnson and Matthew Maley. Instead of the normal introductions, I'm going to let these two folks come on and do a little bit of their own intro. I think you're going to really love their resumes. Super impressive two guys. We've done a show together on Benzinga in the past. So I think the show is going to be great. We're going to talk about the markets. We're going to talk about the end of the year 2020, this crazy COVID year. We're going to look into 2021 a little bit. We'll take some questions. I think the guys have a few stock picks for you as well. So I'm excited. We haven't done something like this. So let's get these two gents out. Let's welcome Adam and Matt onto the stage. Come on out, gents. All right, so Matt, you're back on the top left. AJ, you're down on the bottom. So we've switched again. Welcome.
All right,
guys. Sounds good. You want me to start or?
Yeah, go ahead, Matt. Tell us a little bit about yourself. Give us the elevator pitch of a little bit, and we'll move to AJ.
Sure. I've been on Wall Street for well over 30 years now, and I started. It's funny because I do kind of a two-pronged job. That I'm the strategist, the chief market strategist at Miller Tabak, a small brokerage firm on Wall Street. But before that, I'm much different than most strategists, most macro people, because I start off on a trading desk. 25 years at Solomon Brothers, the first 15, which back in the 80s and 90s was one of the most powerful trading desks in pretty much all markets back then. If you've ever read Liar's Poker, you know the book. It's a very entertaining book if you don't know it, but good to tell you about Wall Street back in that era. And then at Merrill Lynch, which obviously one of the biggest and most important trading desks, for about 10 years. So 25 years of trading, and that gave me a much different, unique view of things. Rather, I try to look at not necessarily what should happen, but what is happening and what will happen, because what we learn in the classroom in the real world doesn't always work out, and in the markets it really doesn't work out sometimes. And it's like one of my favorite old sayings is that everybody in Wall Street says the market's always right. Well, that's couldn't be further from the truth. The market is only always right eventually. And so as a trader, we try to look at those. When you get those big divergences, that's when you can get some really big, that's when you can really make the most of the profit. So so that's kind of what I do for Miller Tabak and for the institutional business. On the individual side, I have a market letter, two market letters, actually, the Maley report, which I do through Benzinga, and then also the Benzinga stock pickers, a letter which we just started a couple of months ago, which has a couple of different levels on it, and so far so good. It's been working out very well. Great. And but try to look at the market in a unique way, long term sometimes, but really look for those shorter term, intermediate term opportunities to where you can really maximize your returns.
Perfect. All right, good. And Andre will put all that in the chat for folks too. And then AJ, how about you? Give us a little bio on yourself.
Yeah, so I write Bullseye Brief. This is my investment letter. I put out one new stock pick every week. And my whole thing is American ingenuity, the people and companies driving this world forward. So a lot of my picks are tech, biotech, medtech, but occasionally there'll be an industrial in there that might be doing something exciting, whether that's a Koppers or an Arconic. I try to find names that you don't necessarily traffic in. I'm not going to tell you about the FANG stocks. I'm going to help you find some biotechs that may go up 300%, 400%, 500%. At least I certainly hope so. Returns have been very good this year, but I'll tell you, I was down a lot in March too. It's been a crazy, crazy year. And Matt, thank God, I'm with you, what you just said about the market not being right. If the market were right, then there would be no opportunity for guys like us, right? Because we're stock pickers and we go out and we find those opportunities. And I absolutely love what I do. If I look familiar, it's because I spent a few years at Bloomberg, anchoring a show, actually a couple of shows over there during the financial crisis. I was going on as a guest and they said, would you ever make TV a full-time thing? And I said, okay. And I did it and I loved it, but I missed having a P&L. I missed being my own boss. I miss, just being in the business. So I launched Bullseye 4 years ago. Again, one stock pick every week. Returns have been good. And I do absolutely love what I do, even on the hard days.
Yeah, I know. Trust me. I'm not nearly in the realm of the world you guys are, but I was a trader, right? Yep. It is something else. And I got to tell you, I don't know if you guys feel this way too, but my highs from making money weren't close to the lows when I lost money. I don't know if you have the same emotional reaction I had, but I was like, ugh, those bad days were tough.
They're tough. Well, just regulating my own emotions. I mean, my intraday volatility right now is insane.
Oh
I mean,
boy.
I was up a couple of percent today at 3 o'clock, and I finished the day flat. I mean, what happened to my 2% my 2% gain? Just like poof. But that's the world in which we live right now.
Yeah.
All right,
Yeah.
good.
There's no
Well,
question. It's
let me say, okay, so if you have questions, Andre's going to handle questions. There's a Q&A button down there. I've got that up. Fire that up as needed. We're probably going to do questions toward the end, but if things are pertinent as they come up, we'll fire them in as needed. And we're just going to go through a few segments. We talked about this pre-show. Let's just get a year in review. I know COVID 2020 has been just insane. From our side of the business, certainly very active. Okay, option volume and I'm sure stock volume has been out of this world. I'm not sure we can look forward to that. I don't know. But let's just go through a year in review of sorts, maybe some of your highlights and lowlights for the folks, and we'll go to each one. We're going to talk a little bit about what we can expect through the end of the year, what your opinions are there, and it can be stock specific too. That's okay. And then let's just delve into 2021, a couple quarters. We have potentially a changing administration and some thoughts around that. What do you think? And then a few stock picks. Sound good?
Love it.
Okay, Matt, you want to start? You want to go first with the kind of the COVID 2020, I don't know, recap, any highlights, lowlights, or things we should know about?
Well, yeah, I mean, one of the things, the great things that one of the things that I really try to do is we're always trying to hit singles and doubles here and there, but we always want to get those big home runs too. And one of the ways I've been able to do that is finding the key turning points, whether it be in a market or an individual stock or a group, and therefore the ETFs, or even in a separate asset class away from the stocks. Because of course, with ETFs now, you can get involved in those, whether it be in emerging markets or for some foreign markets, et cetera. But one of the things I did, I mean, as we move towards the end of January this year, I was saying this is crazy. This virus is a big change, and whereas market is ridiculously expensive, I beg people to raise cash, pound on the table, raise some cash. You're going to have some great opportunity to buy some stocks at cheap levels. Then in March, when things looked like it was complete flush in the marketplace, I flipped and said, okay, time to buy. Now, I wish I could say I said buy with both hands. That's something I said at the end of 2018 on Christmas Eve when the market was really getting flushed out. Mm-hmm. So I said one that I really missed is like, geez, I wish I had just said buy with both hands. But I was more talking about creeping into the market. But I did talk about how I thought that the FANG stocks and the stay-at-home stocks would outperform coming out of it, and of course they did. And the thing about it is we moved through the year, and believe me, when I thought we'd see a rally in those FANG stocks from March until August, I didn't think this would be as strong as it turned out to be. Mm-hmm. But we did ride him, and that's one part of the thing about trading and trading styles, that you can buy what you think is a short-term trade, and just stay with it. You use stop orders and you just raise them as they go up if you're on the long side, and of course lower them on the way down as the market goes down. Mm-hmm. But we're shifting now. I shifted again towards the end of the summer only because I just thought the market was ridiculously overbought in these FANG stocks. It was too narrow. People kept trying to say, don't worry about the narrow market. It's different this time. Well, it never is. And so we got another call there on the top of the market and really looking for the market to come in. Right now, we can talk about this, I know, a little bit more. I'll let AJ talk his review on the year. But I'm thinking that the market will see a nice year-end rally, and the action of the last couple of days sets us up well for that. But I'll wait on that.
Okay, go ahead, AJ. Fire away. Do you have some thoughts on the year?
Yeah. I'll at the risk of sounding like a broken record, and granted, no one listening has necessarily heard what I've been saying all year, but I'll repeat now what I have been saying all year, and that is, and now we're closer. We will have a vaccine. We are getting through this. Mm-hmm. People are going back to work. The economy is rebounding. The stock market will make new highs. There is a lot to like right now, from the vaccine to low rates to this economy revving back up. I've been, again, at the risk of sounding like a broken record, I've been very positive through this. I took heat in March. I was down a lot in the middle of March. I did double down. It's the first time in my life I have ever gone on margin. I went up to about 110%. I never do that. I'm just not a margin guy, but I did in March. It paid off. I've been doing some selling recently just because names hit my target. I have an absolute credo that before I buy a name, because you're only rational once, and it's before you buy the stock, right? Set a target, and if the name gets there, sell half. So I've been doing some lightening up. A few of my names have hit their targets. And at this point, I'm about 92% invested, so 8% cash. And I think that's the smart thing to do. As you start to make new highs and those names hit the targets, you sell them. And then I just, work the balance. I don't try to trade the market. I just try to focus on my names. I have 33 in position right now. I feel good about where we are. I feel good about what's happening. And Matt, I'm totally with you. I think this thing is set up, this thing being the market, for a pop into year end and into next year. I'm not a chart guy, but you look at those charts and it's just, you could just see, it just wants to. Again, I focus on the names, but I can't help but ignore the bigger picture. And I do like the setup right now. That's my take on where we've been and where we're going. It's a good place. It's what I've been calling the Wayne Gretzky trade. Don't skate to where we are, skate to where we're going, and where we're going is good.
Okay, well, that's good to know. So one of the things we see on our end, and I was talking to Matt a little about this pre-show before you got on, AJ, is we look at the VIX complex, right?
Yeah.
A little bit. So I look at it a little bit. There's other educators in our space who do that. And the VIX is setting up classically in what we call contango, right? So it's got this sweeping curve that VIX front month is lower, and it kind of peels into a concavity of downward sloping. It's very traditional. And when it's traditional, it means, guess what? We're gonna try to march higher. And it follows the SPX, right? That the volatility in there. So it's always an indication that we potentially could start moving ourselves higher when it gets like that. Now, during the COVID times, I think VIX got up to 80 or something. I don't know, some crazy number, right? That's when we went to 80 prior to this. Everyone said, we'll never go back down to 15 again. Well, guess what? We went to 8 or 10 or something like that. And we went back to 80. It's going to happen again. We get it. But it's in a very traditional standpoint. And that kind of confirms a little bit what you guys are saying about what your outlook is for the rest of this year. Now, and I qualify that. The disclaimer is it doesn't mean it has to do that, but that's what it's looking like. That's what the market.
No, yeah. I totally agree. And I just, one of the things towards the end of the year, and we have to remember, is that the market has been very dependent on liquidity in the last decade or so. And I mean, we saw what happened to the market when the Fed finally started tightening. It took a while for that tightening to have an impact, but the market finally cracked back in 2018. But one thing is we have now is we have this thing that they've been they started in March, this huge, massive stimulus program. We've had a fiscal stimulus program as well, which is no longer working right now. But it's the one thing is though that the Fed is still there. And the reason why I highlight that is that last year, the market rallied into the end of the year, in the fourth quarter, especially, into the end of the year and into the new year. And a lot of that had to do with the Fed liquidity that they were providing because of the big crisis they had in September of last year in the repo market. And if you don't have a repo market, you don't have a financial system. And they kept saying it's not repo. They kept saying it's not QE. As I used to refer to it, it was their not QE program. But they were definitely adding a lot of stimulus. And that was a big part of the year-end rally last year. A lot of people don't remember that. And I think that will continue again this year. And the fact that we've had a couple of hiccups yesterday and then today, this afternoon, and it could last for a couple more days, that would be good and healthy, because we saw the same thing last year in December, very, very, very beginning of December. The market went down a couple percent. That was a perfect thing, washed out some of the overbought conditions, some of the the euphoria in the marketplace, and allowed it to rally into the end of the year and into the new year. And let's face it, the market's not going to top out on December 31st or January 2nd, whenever it does top out. But I think it'll go into the very first part of next year. So don't fight the Fed. They're still providing liquidity, and the reason they are, and the reason they will continue to, is because of this new wave of the coronavirus is causing lockdowns, causing shutdowns. They want to avoid that from killing the economy, especially since it doesn't look like we're going to have a fiscal thing. And even if we do, it's going to be small, number one. And number two, that hurts the credit markets. And they cannot, again, they did what they did the repo market last year because of what's going on in the repo market. Then they did it again in March because the entire fixed income market shut down and they had to come in and provide liquidity. They want to keep that going. They don't want to have to come in and wait for things to slow down or shut down or lock down. They want to keep it going, keep it humming. And maybe in the spring, they may start to pull back a little bit once they know the vaccines are coming and the weather's getting warmer, and et cetera, et cetera.
Okay. And then, you know, we can lead into AJ. We'll let you go first into 2021 a little bit. I guess we gotta have a question. So let me blend this question into the thoughts in the early part of 2021. Looks like we're gonna have a new administration. And the question is, does a Biden presidency change any outlook at all into 2021? Is there anything to think about, you know, relative to that? We can get into specific stocks in the last segment relative to all that. Any thoughts there, AJ?
Yeah, I'll tell you right off the bat, assuming that the two Republicans in Georgia win their Senate seats, a Biden presidency doesn't really do a whole lot to change anything. It's status quo, which is just fine, by the way, because in the past, when you've seen a Democratic president and a mixed Congress, you've had an annual return for the S&P 500 about 13.6%. So to me, this is Goldilocks. You have a president who wants to be stimulative, and you have a Senate that's going to hold him back, which means you don't have a whole lot of change. You also have a House that has gotten narrower, so it's harder for them to do anything. You don't have a Green Deal. You don't have tax raises. The one thing you might get, and we've been talking about this, and everyone, for years, because it's the only thing Washington can agree on, is some kind of, you know, stimulative infrastructure package. We probably will get some more stimulus, especially if we see the lockdowns. I don't know when that'll happen, but we probably get it. So again, to answer your question, do I think a Biden presidency has a big change? No, I do not. Provided that the Senate stays GOP, I think you just have status quo.
Okay, good. Thoughts there, Matt?
Yeah, it's funny. I definitely agree with AJ, but I have a little different take on it. And I think it may make for a tougher year in the broad market after we get past the first quarter or some point in the first quarter, especially as we get towards the spring. But it's going to bode incredibly well for what AJ does, because if the markets has a tough time, this whole thing with, you're talking about healthcare and biotech and tech, this individual stock picking is going to be huge, even much better. But let me tell you why I think I'm a little worried about just next year, again, in the new presidency. And the reason is that before Trump, the vast majority of presidents, whenever they come in like with a new infrastructure deal, which I think they will try to get. I totally agree with Adam. But what they tend to do, no matter what their new fiscal programs might be, no matter what presidents, you go back 60 years, what they do is they come in, they go, great, let's sign something. It makes a lot of headlines. But what do? They back end load it until the last 2 years of so they can get reelected. Okay. Now it's true. I mean, you go back. And they don't care about the first year. Sometimes they have to make some tough decisions. Right. But who remembers that we had a recession at the beginning of Reagan's first term? We had a recession at the beginning of Bill Clinton's first term. Both of them won in landslides because their last 2 years were fabulous. And again, I'm not saying they cause it. They purposely want to cause the economy to go down or the stock market to go down, but they don't care. They back end load this stuff. And so it's another reason. Why do first term presidents always lose seats in the midterm elections? Because the first 2 years aren't that good on the economy. Right. And the second 2 years are great. It's this whole thing, this presidential cycle that we've all read about. It's not there as a coincidence. There's a reason behind it, and that's the reasoning. Yeah. And guess what? Trump didn't follow it. He front end loaded all his things, and it's very hard to keep your economy going for 4 straight years. Look what happened. We had the pandemic. and
Yep.
he lost, or at least it looks like he's going to lose. It
So,
looks like he's lost, or whatever.
right.
So that's my thinking. And then in that kind of situation where we have a rough, maybe last 8 to 10 months of the year, a rougher, and we get a pullback or correction, boy, the stock picking, especially in the areas that Adam specializes in, is really going to be helpful, because we still need technology. The coronavirus isn't going to end the inroads we have in healthcare, especially with things like mental illness and stuff. It's just great opportunities are going to result from this.
Okay, great. Let me ask one of the questions. It kind of fits here. Doesn't kind of. AJ, you mentioned if the Senate stays as it is. What if the question is, what if the runoff doesn't go as planned? Is that some sort of havoc in your mind, or do we kind of rotate into something different in terms of what's valuable?
Well,
In that element.
yeah, let me pick it apart in a couple of different ways. Well, first of all, I'm not sure I trust any polls anymore, because they're generally wrong, right? But I will say that I have yet to see a single poll which says both of those seats go to Democrats. In fact, almost all the polling says that the Republicans probably hold them. And then there are a couple of marginal polls that says, okay, maybe Loeffler loses her seat. Okay. Now it's 50-50 effectively once you get, the vice president in there, because it's truly split, on a split vote, by the way.
Yep.
So I don't think that we actually have to spend a whole lot of time addressing that possibility. But just to answer your question, Lex, if that did happen, if we had a Democratic Senate, yeah, that would make me a little less bullish. I mean, it still, they're going to have a hard time getting anything done, but that would be a little more problematic. You don't really want to see blue. I mean, you want some red in there. In the same way, you don't really want to see red. I mean, you want balance.
Okay. Okay.
So
Good.
that would upset my Apple basket or my Apple cart or whatever the metaphor is.
Yep.
But I don't think that's going to happen.
Okay. Okay. Good. I think that answers the question. While we're here, let me just take a couple of these questions, because we're getting a few here. So, question is that, and I tend to paraphrase these a little bit from time to time because they're long. We've had an incredible run up, okay, back almost to the highs, eclipsing the highs. Is it important to have some part in cash? I guess, and the question has a bunch of percentages. I'm not going to go through that, but yes, no, maybe so. Adam, I think you mentioned you have maybe 92%, or I'm sorry, 8% in cash. Is there some other metric out there? I guess is the gist of the question. That is a rule of thumb. Matt, you want to start first, or?
It's. I think now. I mean, you always want to have a little bit of cash on hand. Although, as AJ said, when you get this, when you really have a lot of confidence, and again, especially when you get a situation where they've thrown the baby out with the bathwater through forced selling. Remember, crashes never ever happen because of a bad economy, because of high inflation. It happens for one reason and one reason only: forced selling. And it doesn't happen that often, but when it does, then you can really go in there. But it's always good to have a little cash on side, because a new idea comes in and you want to be able to take advantage of it without having to sell another good idea. But right now I'm kind of thinking I'm going to be raising cash after we move into the first of the year, because of the concerns I have about the amount of stimulus, what will be coming later rather than sooner on the fiscal side. Okay. And the other thing too I worry about is with the Fed adding stimulus. When if the market runs, especially if it runs up a little bit more, like I think it will, I mean, they don't want to create another bubble that suddenly causes causes them to lose control. Sure. So it's they lived a lot of liquidity for many years after the last crisis, but that's because the market was cheap. But they're getting really expensive. I don't think they want to push it. They really just want to provide a safety net for the fixed income market. So raising cash, I think, and getting a little bit more defensive, maybe putting in some hedges, is something I'll probably be looking to do in the first quarter of next year rather than right now. Okay.
So, and AJ, any other thoughts on that line for you?
No, only to just underscore that as my individual names hit their targets, I will be selling. I always sell half when it hits my target. And if you've hit targets, as you know, they should with the market making new highs. I mean, good. My targets were in line with the market making new highs.
Right.
Fine. So I'm doing a little selling. I've got 8% cash. A week ago, I had 0 cash. So I'm okay with that.
Okay.
Yeah. And you know, realistically, as I look at my portfolio, there may be another sort of 5 or 6% that ends up going into cash, just because I think a couple of those names could hit targets. But
Sure.
and if I finish the year at 85 invested in 15 cash, great, fantastic. I'm good with that.
Good. Okay, good. Before we get into the stock pick part of this, we're going to head there next. The quick question from Mark, maybe it's not a quick question. In your research into the Fed, what is the effective return rate on the Fed balance sheet? And do you have a link showing that rate broken down by asset? Now, again, I promised you I know nothing about that. So I read that question and I didn't paraphrase it because I don't understand that stuff. So if you have a quick answer, let us know.
I do not have a specific thing, a rate of return when the Fed. I mean, it's weird because we saw what happened with the balance sheet. Just because the balance sheet is shrinking, which doesn't mean that the stock market's immediately going to go down. I mean, when the Fed started tightening back in 2018, or I guess it was actually technically started in 2016, but through 2018, the market kept going up for a while. And then they started tightening by raising rates, and they started tightening further by shrinking the balance sheet. It wasn't until the fall that the market started to go down. So it's not a real good leading indicator. It's been a little bit more lately, but even then we saw a huge rise in the balance sheet over the summer, especially in the spring and summer. Then it's leveled off, and yet the market still held up and still kept rallying even after the Fed balance sheet had leveled off. But you do want to know whether they're providing more, and also the key thing is, what are their goals? And one of the things right now I think is very important is the goal they flat out stated, and right after for several years after the credit crisis of 10, 12 years ago, they said our goal is to raise asset prices so that'll help the economy. Now they're saying they want to keep the bond market stable. They don't want to push asset prices a lot higher because it'll cause a bubble. So we need to be a little bit careful about what the Fed will be doing. The last 2 times they've really pushed the market higher, they did it because they were protecting the bond market, not because they were trying to specifically push asset prices higher.
Okay. Okay, that sounds great. We'll come back. There's another question on that, but let's come back because I want to get into some stock picks. I'm just checking time. So AJ, what do we say? What do you say we start with you?
Yeah.
Let's do. You guys want to go 1 and 1? You want to do a couple and comment on each other's? How do you want to proceed? What's best for you guys?
Well, I'll tell you what.
Yep.
Let me just toss this out there.
Okay.
Everybody hates oil. I think oil is the hardest trade in the world right now, but they're percolating. So can I give you a couple oil names?
Please.
And then, Matt, weigh in?
Yep. Perfect.
Likewise, Lex?
Yep.
Okay, cool. I'm a former oil trader, so I do have an opinion or two on oil. And I traded jet fuel, which was the coolest thing in the world to trade. By the way, I don't know if you know, like jet fuel, what creates demand for jet fuel is not jets, because there are always jets flying around. It's the marginal demand that you need because jet fuel has a lower freeze point. So in the Midwest, in the wintertime, they put jet fuel in the diesel tanks. So all the trucks driving around have like 5% jet fuel so that their diesel doesn't freeze.
That I did not know.
That's what drives the spread between heated oil and jet fuel. Anyway, whatever. Okay. EOG. I love EOG. It's the single best E&P out there. Ticker, obviously, EOG.
Right.
It's amazing what these guys can do. They have the best acreage, they have the best technology, and they most importantly have the best balance sheet. They only pay for drilling on new wells with cash flow on existing wells.
Okay.
And they're huge in the Permian. Love EOG. Pioneer, PXD, is also big in the Permian. And, these names are percolating. They're coming back to life as they should. The Permian is where you want to be. Both EOG and Pioneer have like $22 to $23 break-even prices.
Okay.
That doesn't cover the new exploration. Just once you actually sink the well and you're pulling it up, as long as oil is north of, low 20s, they're making money. ET, Energy Transfer, for people who like dividends, this thing yields like 10, 11%. And that's with the dividend cut in half. It's the largest pipeline operator in the country. They have about 1/3 of all the pipelines in the US. The assumption is that Biden is going to, is going to make life hard for these guys. But again, my whole balance thesis is that no, that won't happen. And it's trading at like 4.5 times earnings. So 4.5 times earnings, 10% yield, ET. And then finally, LNG is the ticker for Cheniere. They're the big exporter, really cool business. They buy nat gas here in the US. They freeze it down to shrink the volume by 1,000 times, put it in a tanker and send it overseas. They have 20-year term contracts, the people that are supplying them on the one hand versus the people that are selling or buying the oil on the other. So they're just locking in a spread. People trade this thing as though it's, you know, an exploration company, like it should move with the price of oil. No, it's a spread trade.
Okay.
Those are my 4 names in energy. Everybody hates energy, but it's starting to percolate.
Yeah. So I'm just pulling up some charts as you mentioned these, and well, maybe LNG too. They all look like they've been pretty hammered over the course of a year, right? Safe to say, hammered, right?
Hammered.
Okay. Matt, do you follow any of this stuff?
Well, yeah. It's funny. The EOG, which is the symbol on that stock has been EOG since forever. But the company's name used to be Enron Oil and Gas. Now, I bet you can guess why they changed the official name to EOG. But and the thing was, it was smart to do it, obviously, because Enron was a farce. But EOG back then and to this day has a great management team. So and boy, that's one thing that AJ's talking about. Some much more, let's say, they're just as important things, but it is important to have the kind of management team. And for a while there, people are like, Enron Oil and Gas, is that like,
Right.
and they had just the opposite. It did and still do. I mean, new people have come in and stuff over time, but great company. And so I totally agree with that one. The one that I like too, you mentioned too, we're talking about dividends. And I, on my stock picks, just for the long-term stock pick that I had now, at the time it was yielding 8%, the stocks rallied. This is Chevron. It's an old-fashioned name, but it's, great company, great, a great management team. They are dedicated to keeping that dividend. Exxon's got a higher dividend. They're not so sure about whether that's going to stay there or not. I mean, so the Chevrons are just a great long-term holding. They pay for you to wait with that dividend. Even though it's 6% now, just over 6%, it's still and it's a rock solid dividend. So that's great. The other one I like, OVV, Oscar Victor Ovintiv, is how I pronounce it. But that's more in the natural gas area. There's another good dividend yield, 6%. But the one thing I really want, some of these stocks on a very short-term basis have become overbought. The other one that I have that's actually in my picks and my official portfolio is Baker Hughes. This stock's already up 20%, getting overbought near term, so I don't want to chase it here. But the thing is, going into the end of the year and into next year, here's a group, as AJ is saying, it's starting to turn. I mean, a lot of these stocks, just a couple of weeks ago, were trading at the same level they were trading when oil was at $20. I mean, it was crazy. And even though they're still trading at levels that were much more than the underlying commodity. And so, again, you ain't going to race into these names, but if they come back a little bit in the next, I'm not talking in the next couple of months, over the next week or so, they come in a little bit, great opportunity to buy because they're incredibly underowned. And we've talked about this before, but when institutional holders that can really drive the markets, everybody's talking about how the individuals driving the markets today, and that's true to a degree, but the institutions, if they don't own a group and it starts to move, they've got to get in. If it starts to move at the end of the year, then they've really got to get in, because the ones who are behind the market are they may lose their job if they're behind the market. This is an opportunity for them to catch up. But even the ones who are ahead of the market are like, I want to stay ahead of the market. So my bonus was going to be big. Now I'm going to be even bigger. And they pile into these gains, especially when they're completely underowned. You can't, it's less than 5% of the S&P, ridiculously underowned. But the same thing happens in the beginning of a new year. They go, oh my gosh, what's going to work this year? I can't miss the boat. I don't want to fall behind my bogey in the first 2 months of the year, or the first 3 months of the year. So they pile into those names again. So this is just really set up on the things that AJ is talking about on the fundamental side, and it completely has nothing to do with fundamentals, but it's also a key thing to where you can outside, looking beyond the fundamentals is a great way to really maximize your returns, especially when the fundamentals do back you up.
Okay, great. So safe to say this energy component, pretty good place to take a peek at, right?
Oh yeah.
Okay,
For sure.
great. So the next question is, again, there's a lot of this questions about this Biden presidency. What about the travel industry? And I think that's more of a COVID question. And the question's more about Boeing. What any thoughts on Boeing? I don't know if either of you guys follow that at all.
Yeah, I was selling some of my Boeing calls today on the open.
Okay, so what do you have to say about Boeing? Maybe the airline industry at large, if you can weave that in as well, AJ.
Yeah. Yeah. Okay. So I usually buy stocks, but I was already 100% invested, so I didn't have any money. So I went out and bought some Boeing calls, right? So two ways to skin a cat. So I bought the Jan 200 calls at
Okay.
like $7 when the stock was like 150, and I sold some today at 28. But I'm still keeping a few because I think they could pop this thing higher. It's the perfect, wonderful storm, not a bad storm, but a perfect good storm for Boeing, right? Because now they can fly the 737 and we have 2 vaccines. So I still like my Boeing, but I think, when you get pops, and that's just kind of a trading 101 thing, and Matt, Lex too, you guys probably both have a view on this, right? If you like a name, but it suddenly pops on news, there's nothing wrong with selling a little something, right? You can always buy that. You don't have to sell the whole, just sell a little something, So that's what I did this morning with my Boeing call.
Okay, but generally though, and Matt, weigh in. Boeing, we like it. I think that's kind of your thought. Not me.
Yes, definitely. And just on what AJ just said, it's like the last person who lost money taking profits was nobody. So nothing wrong with taking a few chips off the table. You don't have to take it all off, right. Depending on how your whole risk profile and stuff. But it's always good to take profits. But yeah, the Boeing situation today was interesting because the stock, we got this good news and the stock rallied, opened up 5%. Great for AJ to sell his calls on the opening because the stock closed down. It closed down like 2%. And people say, "Oh, it's the old sell the news. All the good news is out. The stock's going down." I don't think so. A lot of times sell the news is really just, oh my gosh, the stock is really overbought on a very short-term basis. Right. And it's just doing what it would normally and would be normal and healthy for it to do. I mean, the stock's up 50% since the beginning of November. Okay, so 50% in 2.5 weeks, that's way overbought. And it's 140% since March, okay? Mm-hmm. But it's still 50% below its 2019 highs. So it's still, and it's the big problem that's really faced is behind it. Now with the 737 and the COVID, again, that's still with us, but we have vaccines and I'm so much worried about what's going to happen this winter. But as the summer comes, the summer months come and people are like, okay, I can get back on a plane because it's getting warmer, but it's going to continue because when it gets cold again next fall, we're going to have a vaccine that's widely available. So there's a lot of reasons like Boeing. I think it'll probably pull back a few more days here. Today's intraday reversal tells us that some of the froth has to be taken out of the market. So I wouldn't jump in here, but over the next week or two, again, another one where for long term, I think it can go easily break it. I was just looking at the chart right here. Yep. I mean, the key level I'm looking at right now is basically the 230 level. You break meaningfully above that, it's good. It's going to get a lot of that momentum money is going to come charging into it again, and it's going to fly. I mean, $300 is I think is an easy call in the next few months.
Okay, great. Matt, how about a pick from you? Something that you're looking at or like? Anything standing out in your mind?
Well, one of the ones that, and I'm going to use this because it's in the commodity area as well that we just talked about at energy stocks. But it's also, I think, helpful for a little tutorial of a key rule to follow. The rule doesn't happen every year, but the stock I'm talking about is Glencore. It's actually an overseas stock, but they do have an ADR, and so you can easily buy it here. Okay. In the U.S. without any problem. But I am a believer in the number one, that inflation is going to pick up next year. I'm not looking for some people are looking for huge takeoff in inflation. But much like it is with energy, the whole commodity sector has been beaten up since 2011. It's under-owned, it's undervalued. I mean, and first, another thing, Glencore pays an 8% dividend yield. Okay, so again, they pay for you to wait. I first got into this when the stock was at about 450, now it's at 5, so it's had a nice run so far, but I think it can go a lot higher over time. And again, it's this whole situation where on a macro basis, I look at the amount of debt we have in the world, especially in the US in particular, but around the world, corporate debt, government debt, total debt is just off the charts. We're in a somewhat of a corporate debt bubble. There's really only one way we can get out of this without a complete catastrophe, and that's to inflate our way out. Again, I'm not looking for 1970 style inflation that most of the professors who teach at colleges nowadays, oh, it's next inflation is going to be, I've been hearing about a huge pickup from inflation for 10 years, ever since the Fed started their QE programs, and it hasn't come, but it should come, it should pick up. Now, just one last thing, the other reason why I'm talking about this stock is that it's a great tool to use for a key rule is that sell when the smart people sell. Okay. When the smart people sell their companies, okay? If a CEO like the Pfizer guy just sold 60% of his stock the other day, that's not good. I'd liked Pfizer before. Now I'm like, well, wait a minute, 60%? But the real thing is, look at the smart companies that have IPO. In other words, they've sold their companies through an IPO. Goldman Sachs did it. When did they do it? 1999. What happened a year later? The tech bubble burst. Blackstone, one of the biggest PE firms in the world. When did they sell? They sold in 2007, 6 months before the credit crisis blew up. Sam Zell, he was a private company, held his real estate company. When did he sell? This is his whole life. Real estate's his whole life. But he sold his company. He said it was because he knew the bubble was there. It was time to get out. Okay. And Glencore did the same thing in 2011, the spring of 2011. They went public after 20 some odd years of being a private company because they saw that there was a bubble in the commodities area, and they sold. So one last thing. I'm sorry to keep rambling on here, but okay. Just because a company goes public doesn't mean they're selling. They say, well, wait a minute, Microsoft, they went public, the stock took off for the next 15 years. Okay, yeah, that's true. But you know how much the founder, Bill Gates sold? $1 million worth. That was it. He sold practically nothing. He wanted to get out of his mother's garage, so he needed a few extra bucks. That was it. He said publicly, "I want to buy on this IPO." It was the venture capital guys who sold, not him. So not just because it's an IPO doesn't mean the company's selling. But watch what the insiders do when they sell. Get out.
Get out. Okay, good. And that's easily that information's readily available. I'm assuming on the internet. You can.
Oh, absolutely.
All fully disclosed. They have to disclose that.
Right.
Insiders, right?
Right. Okay. Absolutely.
Great. Okay, good. Well, I'll tell you what, let's do this. Would you guys be cool with, we're getting questions on specific stocks. If you don't have an opinion on it, we'll just roll through. That's certainly fine. And then we have few questions on, I'd say, how do I define this? Sectors. And it looks like most of these sectors are sort of, not sectors, but areas that have been hit by COVID, and people are curious about, is there a post-COVID world that we need to know about? So let me start there first, and we'll get a few specific stock picks, and then we'll close it up. How's that sound?
Love it.
The first question is about commercial real estate. I don't know if I even have to say the question. What's thoughts on commercial real estate? And I think the theme here is COVID has proven that we might be able to exist in a world of Zoom, potentially. Do these big corporations cut that back in major cities? And what effect? Obviously, I know what the effect is if that's true, but do you have any thoughts? AJ, I'll start with you. Go ahead.
Yeah, I'm long Boston Properties, ticker BXP. It's the largest owner and operator of super high-end, high-class, high-quality buildings in the country. Boston Properties, 94% of their tenants are paying rent on time.
Is this it? Can you guys see my screen?
Yeah, there it is.
Okay, so it's way down here, gotten killed. This is a year, by the way. So this is new.
And look at the pop.
Run back up here. So
yeah, so the pop, Lex, if on the far right hand side of the screen, the pop that has recently happened was when the Pfizer news came out about the vaccine. Right. Yeah, so you can see it's responded, and it's doing exactly as it should. And it has plenty of upside from here. I love it. I think you're going to start seeing companies. I know that that New York City schools are going back to lockdown and closing. That was the headline today that knocked the market. But we're going to get through this thing, and I think you're going to see people want to get back to their offices. survey that I saw that came out of one of the big consulting firms is that 67%, 2/3 of people want to get back to their offices because they miss their office relationships. Synergy happens in the office. And the other thing that happens in the office is you defend your turf. It's a lot harder to do at home. And you become anonymous, and all of a sudden, you get fired. So there are a lot of reasons to think that people are going to get back in their offices. And this is the one to own. I wouldn't own a lower quality one. This is the one to own. BXP, Boston Properties.
Okay. Matt, any thoughts on that whole deal there?
Yeah, I think that I totally agree with that, with AJ. The thing is, it's the same thing as corporate culture. It's hard to have a corporate culture, even if you have 10 people in your company, if everybody's remote. I mean, and the relationships and it's just very, very important. So I totally agree. Now, will it come back with a smaller footprint? Yeah, that's fine. But you people are social animals. We do not want to sit at home. I mean, I love my wife, but as she said, I married you for better or for worse, but not for lunch. Okay, so get out of the house. So I totally agree with that. But just if you could pull that chart back up, I think it's a great one, because one thing about technical analysis, it is fundamentally based. I mean, there's a reason why people use them. It's not just a bunch of lines drawn on a chart. I mean, when a company starts doing better, they hire new people, they build new factories and stuff like that, but that takes time. So the earnings don't show up for a while, okay? But the real professional traders, the hedge funds and the big mutual funds, they see this in advance. So they start buying the stock before the earnings turn. Right. And that's why you see people look at charts, and then the stock looks, it starts to turn up before the actual earnings turn up. But in this one in particular, look at the low it hit back in May. And then look where the low it just hit in the late October. Double bottom, boy, and there's nothing better than a double bottom low in a stock. When you love to see that. And now that's a stock. I don't know if it's on there, but the 200-day moving average, it just moved above that. And what we're looking at right now is that if you already own it, that's great. There's nothing wrong to adding to a winning position. Okay. Because yes, your average price goes up, the price that it costs you, but if you own more of it, you're still going to make more money. Right. This stock, if it makes a higher high above its June highs, which is basically $108, okay. You get above $108, you're going to follow a double bottom with a key higher high, and this stock is going to. All that people who said that I'm staying away for that for the next 3 years are going to jump in. And so it's already looking good now. So I'm not saying wait till then, but if it gets above that, that's going to be confirmation. You can even add it even up there, even though it'd be up a lot from where you bought it. Okay.
Yeah. And I've drawn some pictures on here. So that the circle is where it's trading above that 200-day. That's that blue line over there on the right. I see the lows. Here's that high you're talking about, I believe.
Right in there. So it's
that's about 108, as you said. Perfect. Good. Okay. Wow. That's this is
really setting up well.
Yeah, AJ, and you love this stock, right?
Love it. I picked this company apart and I love it.
Great. Awesome. Okay. That's a great one. Next question. Again, very COVID centric. Movie theaters, big venue events, football games, concerts, that whole world stock wise. I'm assuming if you believe in the vaccine, you're probably gonna have a similar answer, but I'll ask it anyway.
Yeah, Wynn Casinos I own and love, super high quality. They've got a 30-page manual that tells all of their employees how to deal with everything from people walk into someone checks a car and what does the valet do with the keys. I mean, their procedures are really good. They screen every single person who comes onto one of the properties. They can screen 15 people in less than 5 minutes, and it's free. So you want a free test, go to Wynn. I love Wynn. At the polar opposite end of the spectrum, one of my subscribers called me and said, "What do you think of AMC theaters?" And I thought, oh, wow, that's kind of a neat idea. It's like a $2 or $3 stock down from the teens. Right. And then I realized, they lease all their theater space. They don't own the real estate. And they had to basically extend all their loans at a 10.5% rate. And they have enough money now on the loans to last them through 2021. That one could actually go under. But I kind of like it because it's like the worst of the worst.
One of the dogs of the.
The worst.
All right, Matt, anything there on the movie theater?
Well, yeah. Movie theaters, I'm not. I'm a little. I agree with AJ. I think I'm gonna go out to win. Before my mother-in-law gets here for Thanksgiving, so I can get my COVID test. But no, but I agree. I mean, the pent-up demand. I have 2 kids in college and one just out of college, and they're just chomping at the bit to do it. I was just looking at the chart on Live Nation, LYV. I mean, the problem is the stock is very overbought. It's very close to back where it was. It's something you got to be careful on. If we do see a big dip, especially gets down towards $60 again, it gets back below $60 and gets down that 50 to 60 range, it might be a little bit more enticing. Because I do think I just had a bunch of, I've been around some of these younger kids in the last couple of weeks, and they're just telling me that they can't wait to get back out. And as we all know, they're getting out when they shouldn't be getting out and getting together when they shouldn't be. Once they're free to do it, they're going to do it at concerts, at ball games. I don't think, and maybe in the casinos, maybe not so much the young people, but people like to gamble. It's fairly obvious. But the movie theaters, you can watch that at home without much of a problem. I still love going to the movie theaters. My kids could care less.
Right? Yeah, they're Netflixers, right? They
Yeah.
turn that baby and let's stream. Okay, all right, let's do it. A couple stock picks for questions on 2 stocks. We're gonna do that because I see the time. So let's do 2 more. And happily, there are 2 that are on your list. And AJ, I'm gonna start with you because I think this is one of yours. AKAM.
Yeah, Akamai.
Yeah, Akamai.
Sure.
So I didn't know that. I mean, I don't know that stock, but I know what it is. Thoughts. The questions, general. What are your thoughts? So let's.
Yeah, I just wrote it up as a buy 2 weeks ago for my subscribers. I don't think we're going to get rich on it, but I think we can make 35 to 40%.
Okay.
My target's 135. I wrote it up at I think it was 95. It's a content distribution network, CDN, largest and oldest one out there. A lot of people talk about Fastly, which is the back end that powers TikTok, because everyone thinks, oh, TikTok's so great. The problem with Fastly is it's brand new. They don't even have EBITDA margins because there's like no EBITDA, okay? Right, Fastly, I won't touch it. Akamai, on the other hand, been in the business since the mid 90s. They have more servers in more locations in more countries than any other CDN or content distribution network in the world. They serve all the major companies.
Right.
They have fantastic margins. It trades cheap. I mean, it's like 17 times earnings. Anyway, I don't think we're going to get rich on Akamai because, again, my target's like 135. If I can buy something, in the 90s and trade it up to 135 over 6 months, hey, what's wrong with 35 or 40% in 6 months?
Great. Okay. Do you follow that one at all, Matt?
Well, obviously AJ's kind of covered the fundamentals pretty well, but looking on a macro level, it's like, where are we in the ball game of cloud computing? Are we in the 9th inning? No. We are in the early innings in cloud computing, so that is great. And if you're going to look on the technical side, back down at the October lows, the very end of October, early November. So again, I'll just look at that level. It was about 94, 93, where AJ talked about it. That was also the low it saw back in April. So again, another double bottom.
Yep. And
now it's bumping up against its 200-day moving average. It got there a week ago, failed. Got there today and failed, but only by a small amount. They didn't roll over, get crushed. When that breaks its 200-day moving average, there's so much those algos, the algorithmic trading. Yep. There's so much of that money in that stuff now. It's much of that is momentum based. It breaks its 200-day moving average after failing twice.
Yep.
People are going to pile into it, and it's going to run even more.
Okay, and then there's that 200-day moving average again on the screen. I'll circle it real quick. So
yeah, right about just below 103.
Yep. So it's kind of doing its thing right there. So,
right. Yeah, it's taking a little breather. That's okay. The market's doing that, but it's when the market goes, it's going to go, and it's going to attract a lot more of that momentum money than some of the other names.
Got it. Okay, we'll stay with you, Matt, for the next one, and we'll call it after this. Nvidia. I think they had earnings tonight. Yeah. Any thoughts on Nvidia?
Well, yeah, okay. Well, this one, I mean, I always like to look at the chart while I'm excuse me. But, yeah, the key on this one, I like it long term. it had this 200% rally from March until August, and it's flattened out recently. Reported good earnings. Last I saw, it was trading higher. The key is the battle lines are well drawn in this stock, and that's why I'm a little bit nervous about because this is kind of one of the mega cap names, and I think people should be rotating out of most of them, not all of them, but most of them. This one I don't put in the same category. There's just too many other businesses that they're involved in, and it made a double top just below 600, and it's broken below. I'm sorry, if it can break back above that. Let me start again. Just below 600. It's really at 550. 550 on the closing basis is where it topped out, both in September and this past month.
Right.
This month, I'm sorry, in the last couple of days, it traded below its trend line going back to March. That's a concern. So there are some concerns out there. If it follows that breakdown of its trend line with a lower low below the $500 level on a technical basis, that's going to be a lower low following a broken trend line. That's not good. That's really not good. You want to get out of the stock then. Okay. However, I'm bullish on the market. It's funny because I did talk. If anybody was watching CNBC today, I talked specifically on this stock about the trading nation. But you get above 575 on a closing basis, that's the double top. I think that's what's going to happen. I'm leaning much more to the bullish side because I'm bullish on the overall market. But if it breaks at that level, again, it's really going to run. And kind of a critical juncture here. It may not be resolved immediately. It may not be resolved for a couple of weeks. But when it is, it's going to see a big move. My leaning is to the bullish side.
Great. Okay. Good, guys. I think let's wrap it up there. I think that's great. So. Both your feeds, or I'm sorry, your links URLs are in the chat. I'll put them in the edited version of this. Is it a paid subscription for this stuff? Can you talk about that at all? If they want to join up and follow you, how does that work? What's the dynamic? AJ, go ahead. Sorry.
Yeah. So bullseyebrief.com. I have a 45-day trial that costs $45, and then it rolls into a quarterly subscription at $295. You can cancel at any time. I do occasionally get guys who sign up for the 45 days, and at 44 they cancel. And God bless you, got full access to the P&L, to all the research, and to me. And I'm happy to have you in there. And I make myself available. You can call me or email me anytime. So bullseyebrief.com. I'm up about 48% this year. It's been a great year, and we're just going to keep it going.
Great. Okay, great. Matt, how about you from your end?
Yeah, I do the Maley report, which is more of a macro view, the MaleyReport.com, and that's something what I put out. Write a note every single day, and then write a longer note on the weekend, which is it's called the weekly top 10. But it's not a review of the past week's top 10 things. I try to focus on what other people are not focusing on. Now, obviously, you can't. I mean, it was like not talk about the pandemic, not talk about, there's obviously some mainstream things that I have to talk about, but I try to look at them from a unique way and help people look at the markets maybe differently than they otherwise would, because I think that's really where you make the big money. If you want to be a passive investor, that's fine. Just go into an index fund and let it ride. I'm not for you, but for the Maley report. And then much newer is the Benzinga stock picks report with Matt Maley. It's actually a couple of different levels. The first level is just 2 picks a month and a very long-term oriented, five years or more. Then I have the level 2, which is which again, I get 1 pick a week, but those could go from anywhere from a 1-week call to a 3-month call, a little bit shorter term. And then a level 3, which is brand new. We've only really been doing it for a couple of weeks, where I do a little call for about 20 minutes, 3 times a week, and talk about some of the things that I'm seeing in the marketplace for real short-term plays. I mean, for instance, I saw huge buying in the Wells Fargo calls one day, and I said, I don't like this company, but somebody just spent a real lot of money for this to go up 10% in 2 weeks. Okay. They're not doing that unless they think they know something. And sure enough, the stock went up 20%. The options went up 300 or 400%. Right. That worked out really well. I have a track record, but I don't want to start, I had one call 200% and I'm only 2 weeks old. It's I'm not going to be able to keep that going, but I've had some real good calls in several other names and short-term trades, and General Motors Ford, both up 50. I'm sorry, over 20% in just a couple of weeks. And Invesco was up over 36% in a month. Those type of calls I try to do on that level 3. The others are a little bit more longer term oriented. For that, I don't have, it's kind of a longer thing, but I should be there on your.
Yeah, I think we have in the chat. So we'll put that out too as well. So and we'll get this on the YouTube channel. So guys, thanks. A great show. We very different, believe it or not, from what we usually do. So we're usually talking about option spreads and all that kind of stuff. But this was terrific. I thanks for coming on. And we'll have this on our YouTube channel, Options Brew TV. You can Google that and get on it and make sure you subscribe. And we'll have this over there by tomorrow. So thanks for coming on, guys. We'll talk soon.
Oh,
Thanks. I really enjoyed it.
Thanks.
Have a great Thanksgiving, everybody.
You too.
Yep.
Bye, guys.
Bye.
Bye-bye.